All right, time to dive in a little bit more into interest and dividend income. So, again, when we look at this is our Schedule B item, and interest income has to be more than 1,500. Really, that's when it's reported on Schedule B. You can still report interest income. Most tax accounts will tell you to go ahead and report it no matter how much you received, just because the IRS does receive those documents. Doesn't hurt. Alright, so the fair market value of gifts or services a taxpayer receives from making long-term deposits or opening an account is actually taxable interest. So when getting a free toaster, which is a rare thing now, but again, the $500 cash or something like that is considered taxable interest income, and the bank will provide a 1099 INT to show it. I like that because that's one of the things that get you on those like free items that end up coming. Now, interest is reported in the year it is received by a cash basis taxpayer, i.e., basically an individual. I don't even know why they put cash basis, but yes, any individual, we do report it in the year that it's received. Now, there's other items out there. One of the cool things is that we have U.S. savings bonds. And these, again, are bonds that come from the government as themselves. And these are sold as what is known as a double E bond. They're usually sold at a discount before 2012 because kind of needed to sell some bonds, or they're going to sell at face value. Again, face value is basically how much we determined that it was worth. Discount is less than face value, thus discount. So we actually get more of a benefit if we bought it. Also, with these bonds, they do increase in value over their life. That's true because they're going to have a certain amount of interest involved. So, when the redemption value happens, so an increase in that redemption value, this is going to be generally taxable when the bond is redeemed and the interest is paid. Again, we're basically being taxed on the interest of the bond. The municipal bond itself, we will not be taxed on, which is nice and everything, because again, we just basically invested into the government. Here's more bonds. The Series HH bond, so double H bond. This is no longer issued by the Treasury as of August 31st, 2004. But since it's still out there, we're going to talk a little bit about it. But bonds issued before that date are still outstanding and pay interest semi-annually. These were issued at face value. Simple as that. Just a little bit of knowledge for that. And again, they're going to be taxable basically on the extra money that comes in, so the interest. Then we have Series I bonds, and these do not pay interest until maturity. So once maturity hits, we receive the cash for that interest. We're going to have to record that interest in that tax year. Hopefully we have a low tax rate. So earnings are adjusted semi-annually for inflation, basically just adjusting how much interest is paid out. So, yay. So we do have to know which bonds we have. We won't get a Series HH bond. We can have a Series EE bond or Series I. I just love how they talk about bonds. You know, getting that government bond, which definitely knows that you're going to get paid out. Again, I do know in 2301 we talked about how bonds work. So if you do want to refresh course, you can check back with your 2301. If you haven't taken that yet, check the YouTube channel. I probably have a video of bonds. Simple enough. But it's okay. We're only focused on the interest. Alright. Dividends. There's different types according to dividends. And we're dealing with ordinary and qualifying. Ordinary dividends in itself are the most common type of corporate distribution. Again, if you don't know what a dividend is, this is basically what is paid from the earnings and profits of the corporation. It's basically your portion. Because with corporations, they get to issue out dividends, which of course is the only, mainly the only double taxation item that corporations have. Because again, it's from their earnings and profits. So they're taxed on their earnings and profits. They issue out the dividend. Then you get taxed here on your individual one for the dividends. Yay. Now, they are considered qualified dividends if the stock is held for 60 days and the dividend is issued by a U.S. corporation. Okay? So it has to have two little items right there. Dividends not considered as qualifying are taxed at the ordinary income rate. So what is that? Again, that is your tax rate. Ordinary. Most companies or most individuals want to be qualified. It's a lower tax bracket or lower tax rate. Pretty much similar to long-term and short-term with that 0, 15%, so forth. Alright. Corporations issuing dividends and brokerage firms holding stock investment for taxpayers are required to classify and report the amount of qualifying dividends to investors. And we will see this on a 1099-DIV. Okay? So, non-taxable distributions. Okay, we do see these. And mostly we'll have this in a big old packet. But when it's a non-taxable item, they are not paid from a corporate's earnings and profits. They are returned on the taxpayer's original investment. That's the key. They have to be a part of the original investment. Basically, you're getting some of your money back. Are not included in taxpayer's income. Non-taxable item, so of course we don't include it in income. And reduces the taxpayer's basis in the stock. Because basically, we're getting payment back from our original investment. Simple as that. Capital gain distribution. When stock reaches a zero basis, further distributions are taxed as capital gains. Okay? That's basically when the stock almost becomes worthless. But if it reaches a zero basis, oh no. So, this is reported on page 1 of Form 1040 or Schedule D of Form 1040. Typically, it's going to be reported on Schedule D. Mostly, we like to keep capital gains all together. You most likely will see it on Schedule D. Alright. Current tax rates for dividends. Like I said, it's a lower rate, usually the same as short-term, long-term, but right now, this is the current. So qualified dividends are taxed at rates ranging from 0% to 20%. Again, the high mark, 20%. And possibly included in the 3.8% of net investment income tax. Okay? Again, these rates are lower than the rates for ordinary income. Okay? That 3.8% is basically if you're at a higher income bracket, you get tacked on with another income tax. It happens. So, this is, again, our tax rates. Again, due to the filing status of our tax clients, we can actually define the income level and basically how much probably is going to be taxed. So again, it's all estimates, but it does help out. So married filing jointly has that 0 to 80,000, where it's 0% if it's qualified. 80,000 and $1 to 496,600, 15%. Anything greater than 496,600 is 20%. Again, pretty much just like we did when we talked about capital gains in chapter 1. So again, you can look over the chart for our single head of household. And marrying filing separate, same thing as single. Qualified widower, same thing as married filing jointly. Okay? So, reporting interest and dividend income. These are our forms. So, interest income, again, generally, is if it's more than $10, they must be reported by the payer to the recipient on Form 1099-INT. Usually we'll receive something from the bank that states the interest. Taxable interest from each payer is reported on Schedule B of Form 1040 if interest is greater than $1,500. Again, most conservative tax people will just go ahead and put the amount on there, and since it's not greater, usually there is not an effect. Now we have tax exempt interest, and that is reported on line 2A of Form 1040. And basically interest that doesn't get taxed. Whew. We're almost done with this. Here's our dividend income. Generally, dividend income, again, greater than $10, will be on Form 1099-DIV. And again, if more than $1,500 in total, ordinary and qualified dividends are reported on Schedule B. Capital gains dividends are reported on Schedule D, as so. So, let's go ahead. Might as well, since we've already looked at the forms for other ones. Let's go back to our friendly IRS. Okay, right here, we're going to look for 1099-INT. Okay, so here comes the form. Again, you can look up the instructions on all. So this is the 1099-INT form. And again, even though it says 2021, there's pretty much nothing that's changed between the two tax years. Here we would see interest income. If there happens to be an early withdrawal penalty, that'd be right here. Federal income tax withheld. There's our savings bonds, interest, investment expenses, so forth and so on. Foreign tax, we do have to declare that. And other items. But we're mainly going to be focused on interest income. Again, we'll put in all of our information. Not too bad. Again, here's the instructions if you really want to dive in and read a little bit more. That's up to you. 1099-DIV. So our dividend one. Here it comes. And here is our dividend form. Okay. Again, this will tell us total ordinary dividends qualified. There's the capital gains. And a couple of items we'll get into when we talk about long-term and short-term again. Also collectibles. Another little item that we're not going to really discuss about. That's mostly art stuff, paintings, and whatnot. Here's the non-dividends distributions are withheld, investment expenses, and of course foreign, and little other items that we're not going to be able to cover. But those are INT and dividends. Not too bad. Again, I love the IRS website. You can find any form that you need. Okay, so we're going to close out this time with after looking at those forms, and I will see you for the next part.